In this week's update, policy error was always going to be the greatest risk. The speed of change is highly significant, and now's the time for caution. It's better to reduce exposure unnecessarily than to be caught out badly. My name's Garry Davis, and as always, this is general advice in this video. And please remember to like and subscribe to the video. I've been doing these Sunday videos now for in excess of 15 years, and members that have been with me for 10 plus years will know that I've made bearish calls on very, very few occasions. I've been very positive for the last 10 or 12 years, and it's not very often that I turn cautious. But I think now the weight of evidence suggests that maybe now's the time to turn a bit more cautious than would be the norm, and that's what this week's video is about. So just a bit of an overall perspective. I would guess everybody knows that we've now got a new variant to deal with. That was always going to be the case. It was never going to be a case of defeating the initial COVID viruses. I think COVID's probably going to be with us for a long, long time in varying forms, in evolving forms. But history shows that they tend to become, any virus tends to become less lethal over time. And so therefore we should progressively see, as the years roll on, we should see less and less impact on the stock market until, eventually it will just become something that we pretty much ignore. But for the moment, that's still not the case. There's still a lot of emotion around the emergence of new variants, and it's something that does have the potential to disrupt the stock market. But I think, putting the virus aside, because I really don't see that is going to have a lasting impact on the market, the greatest risk to the market is policy errors in the areas of energy policy, government spending, particularly in the US, the level of stimulus, and also the Fed response to inflation and growth and government policy. So missteps in those areas, and we're already seeing some of them, and I talked about energy policy last week, then they're the biggest risks to the market. And now it's obvious that the Fed has this very tricky situation of what steps do they take to slow inflation down, which is clearly now far more of a real issue than what was thought 6 months ago, and what impact that might have on slowing growth. And so we're now getting that scenario of rising inflation and therefore a potential slowing of growth starting to be priced in. The market had been pretty much ignoring it, assuming what the Fed had said, that inflation was going to be transient and therefore there wasn't going to be any sort of long-lasting effect. Well, now the Fed has changed their language. They've removed the word transient, and so the market is picking up on that big time and assuming now that we're going to start to see a shift in policy by the Fed. So I think it's likely that the high volatility that we saw last week is going to continue because we're now faced with a new set of circumstances, or so it's perceived. And so there's a readjustment that unfolds, and that's where we're at the moment. So for me, the character of the market is showing signs of change, and I don't change my position based on what I think or what the media is portraying or even what the Fed says, to be honest. I look purely at the charts. I look at where the money is going and base my views on that. And the character of the market is certainly showing signs of change, and that's not something that I say very often. Probably the last time was maybe back in obviously in 2020 in March, but prior to that was the last quarter of 2018 when Jeremy Powell said about raising interest rates, and the market voted very violently against that. So initially, when you get a period of change in the market, initially everything gets repriced, and that's what we saw the Friday after Thanksgiving and in last week. Initially, everything gets repriced. So large, small, good quality, low quality, everything tends to go down, and 95% of stocks fall. But then we start to see huge divergences emerge, and inevitably the lower quality and smaller end of the market will sell off the most. And we saw some extremely sharp sells last week. But then the higher quality end of the market re-emerges fairly quickly. And so it's very much about looking at the multiple areas of market cap, because large cap stocks are going to get more support than small cap stocks. That doesn't mean that all small caps are going to go down. It just means that most of them are going to go down, and you need to be extremely careful if you're buying small cap stocks, because you've got a huge tide of a money shift against you. And then, of course, there's the sectors, and the sectors that will tend to do best are our technology, and if the market does get into more of a negative mindset, then it's going to go a bit towards the defensive sectors of the market, consumer staples, utilities, etc. And then also, of course, growth against value or so-called value, and we're certainly seeing a shift in from growth back to value towards the end of the week. Although that has almost been on a day-by-day basis, it's been flicking backwards and forwards. So the bottom line, you just need to be so clear about what you want your portfolio to look like. And if you've got a portfolio that's got plenty of small caps and plenty of aggressive sectors, then you want to be even more careful than normal, because those parts of the market are at extreme risk. And I think looking forward from here, the sort of stocks that you want to be in are the likes of the Microsofts and the Apples and the Amazons and those sort of stocks. Now, in America, there's probably 100 stocks you can put in that basket. A lot of them are names that are probably not known to most people, but nevertheless, there are some very large, extremely high quality growth stocks in America that I think will continue to do very well. But names like Amazon and Microsoft, obviously everybody knows them, and that's the ilk of stock that I think is going to do the best from here. So looking at the American market specifically, the S&P at the index level only fell 1.2% for the week, which doesn't sound very dramatic, and frankly is not. But when you look under the hood, there's a lot more going on than what that result would indicate. So there's been a definite shift away from small caps. There's no question about that, and it was only probably 3 weeks ago that I was talking about how the breakouts in small caps and mid caps and how impressive the breadth of the market was. And so it's that speed of change where the breadth of the market was great. Mid caps looked terrific. We looked at the MDY ETF, and I'll look at that again today. Was very impressive, and all of a sudden it's all fallen apart. So it's that speed of change which is contributing to my caution. It's just been quite dramatic. Now we're seeing mixed signals on the transition away from growth to value. It's not as definitive as it sometimes is, so I'm still a bit open-minded on that. I think we might see a low in the market form in the next few days. Whether it turns out to be the low or not remains to be seen. But the reason I say that is very much related to the VIX, which I'll come to in a minute. But there is definitely a bias back to high quality stocks. There's no question about that. So again, you just want to look at your portfolio composition. Now the US dollar fluctuated around a little bit, but ended up pretty much where it started the week, just over 96. But it did get up towards 97 at one stage. Now the 10-year yield, money is flowing back into bonds, no question about it. And the 10-year yield fell from, it was only a couple of weeks ago, it was 1.65. Now we're down to 1.34. And the fact that growth stocks got hit as well in the latter few days of the week when the yield is falling, again, is something that is different. that's a shift in the market. Every time the yields went up, growth stocks were sold off. When yields went down, growth stocks were avidly supported. And that is another shift in the market. Now, the main thing, however, was that the VIX hit a peak on Friday of 35. That is right up there. The VIX doesn't get up above 30 very often. It gets over 40 almost hardly ever. But over 30 is not a common occurrence. And what happens is that the market generally forms a low within a couple of days of hitting those sort of peaks. So that's why I think a low should form in the next few days, because the US economy is still strong. Earnings are still good. Now, the market is looking out and it's anticipating that a rise in inflation is going to change things. So it doesn't mean that that's how it's going to stay. But at the moment, given all the circumstances, it just doesn't support a really significant sell-off. And so that's why I think we might see a low in the next few days. But as I said, I think looking a little bit further out, you've really got to be a bit cautious, I believe. So here's the S&P. You can see we had sharp selling on Tuesday and Wednesday. We got a nice rebound on Thursday, and then Friday again was a little bit mixed. We were up initially, then the market sold off quite heavily, and then some late buying came back in. So it's when you look at the S&P, you might wonder why I'm pressing the caution button, but I'll get to that. It's all the other weight of evidence that has me shifting my position. So if we look at some of that, we look at the small caps. This is the Russell 2000 for small caps. We had a breakout on the 3rd of November. Looked good for 2 or 3 days, and now it's all completely fallen apart, and we're back down to the bottom of the range that has been in play now pretty much all through 2021. But look at the volumes. There's always a lot of volumes in something like IWM anyway, which is a huge ETF, but look at the volumes over the last 5 or 6 sessions. This has been emphatic selling. So that would be the first point in the weight of evidence. Let's look at the mid caps. This is MDY. Again, we had a very nice breakout, which occurred at the end of October, early November. Quite a strong breakout on good volume. But look at what's happened since. That's failed with several gaps. We're now back in the range and the volumes are elevated. So there's certainly plenty of change happening there. Now, if we look at the normal spread charts that I like to look at. So first of all, we'll look at the Russell 1000 growth versus value. And we got back to the peak in the ratio that we were at in September last year. But you can see how it got a bit volatile through the week, but you can see how emphatically that shifted on Friday. So we got lots of heavy selling in the big technology stocks. So there's been a definite shift there. If we look at consumer discretionary versus consumer staples, that was absolutely flying. Again, that's come off fairly sharply as well. So another warning sign. And if we look at the small cap growth versus small cap value, it had been struggling anyway. Now you go back to the large cap growth, we were at new all-time highs in the ratio, but small caps have been struggling, and that's now turning over and heading back down. Now the other area that is really important is in the bond market. So what's the money doing with the bond market? This is HYG, which is the ETF covering a basket of effectively high yield or junk bonds. And this is where the move started, and I made mention of this last week or the week before. So we got a breakdown in support. So money started changing position in the junk bond market a week or two ago, and so that was signaling a move to risk aversion. Now that then progressed into treasury bonds, the higher quality end of the market. And we can see with Treasury bonds, they're now being bought. So the price of TLT is rising, which means the yield is falling. And so that means money is moving back into treasuries. And look at again, the volumes are lifting significantly. So there is a clear and unequivocal move of money to a less risk on sort of status. Now, if we also look at currencies, so this is the US dollar index. So we fluctuated backwards and forwards a bit during the week, ended up pretty much where we were. But again, this one I think is really interesting. If we look at FXA, which is the Australian currency, now the US, bear in mind, the US dollar didn't do very much. So this is not a function of the US dollar going up. The Australian dollar has broken down and broken down very badly. It was only the 24th of November that we were at 71.5 cents, and we closed the week down at 69.53, and we broke through two support levels. So the Australian dollar is considered a risk-on currency. We saw, we certainly saw a lot of commodity stocks sold off, and the Australian dollar has been sold off. It just all keeps adding to the weight of evidence that there is a definite shift to risk off. Now, whether that becomes temporary, or whether that is temporary, or whether it becomes something more permanent, we won't know until we get there. But all we've got in the market is weight of evidence. It's not, there are no absolutes. We can only just stack up all the positives on one side, the negatives on the other, and just go with the weight of evidence. And so, to me, there is too much weight of evidence on the risk-off side of the ledger to ignore. Australian stocks, so 69.53 is where we finished, and it's just another in a long line of the winds of change this week. And it's not only the fact that things have changed; it's they've changed so suddenly. And I think a lot of it is around the change in wording from the Fed to remove the term transitory from their discussion. So our index ended up falling only 0.5% for the week, but one would expect we might see a bit more of that. But on Wednesday and Friday of last week, small caps got really roughed up in Australia, and so that again is another another sign that that the markets are definitely moving to risk off. Now, as far as the index is concerned, the healthcare majors, particularly CSL, and the financials were under pressure, but we saw some pretty hefty profit taking in battery materials, and anyone who owns a stock called Novonix certainly would have seen that in spades on Friday. And there is absolutely nothing wrong with that company. Nothing has changed. It's just the market changed its mind about what multiple it was prepared to pay, and the change. I think the stock was down at one stage about 32 or 33% on the day. Those sort of changes used to occur over multiple days. When the market sentiment shifted, stock prices would fall, but those sort of falls would take some time to unfold. The fact that it unfolded in the space of just a couple of hours just shows you how much more markets are going to, or how much more rapidly markets are going to adjust these days. Sorry, just get the right screen. Okay, so if we just have a look at have a quick run through the Australian market. There is the ASX 200. So not a lot of change last week, only quite a small drift down. So it'll be very interesting to see how our market responds on Monday. And bear in mind, I'm not saying that the market is just going to continue straight down from here. The VIX is at a level that would suggest that a low is not very far away, so we could well see a bounce. It's what happens after that bounce that's really exercising my mind at the moment. So there is the materials index. So it had been sold off quite aggressively, but is picking up again, and a good part of that is because China seems to be loosening the reins a little bit, and the iron ore prices come up a little bit. But if we look at If we look at small caps in Australia, you can see quite sharp selling in XSO, and I would expect that that is probably going to continue down. So I think what we're going to see here is all around the world, small caps are probably going to underperform quite dramatically. Whether the index goes up or down, I think small caps will get the worst of it. There is healthcare, big drop on Friday, largely reflecting what was happening with CSL. But finance is definitely now into downtrend. We're below the 200-day moving average, so there's definitely been a shift there in finance. And of course, energy is now down a long way from the peaks that it was at. While I'm here, let's look at Bitcoin. So as part of the risk-off attitude on Friday, you can see Bitcoin sold back down to 53,000, and there's after a really nice breakout, which took Bitcoin up to 68,000. It's been quite a rapid change back into the range. Gold managed to make some ground on Friday. Overall, I think it dropped a couple of dollars on the week. And you can see, looking at the longer term weekly chart, we've come back, we've tested the breakout, but we haven't really gone back into the range yet. So this could be a case of a breakout, a retest of that breakout zone, and who knows, gold may now start to move higher, but I have very little confidence about the short-term movement in gold or silver. And silver has been showing some relative weakness to gold of late as well. So precious metals, gold was down $4, a bit of relative strength, so that was a bit of a positive. But if we look at GDXJ, it was a poor week. There was a bit of stability came into the small caps on Friday, but overall not a great week, as we'll see now. So if we look at GDXJ, which is really my preferred way of looking at the market, because it's just a much broader, I mean, most of the companies that are in this are still large cap, relatively large cap companies. So we're still dealing with pretty large companies. You can see it was a pretty poor week, found a bit of stability, but look, stocks certainly aren't leading the underlying metal. There's no question about that. So it still looks fairly somber in that part of the market. Turning to other commodities, copper was steady at $4.33. Nickel was at $9.24. So that pretty much reflects what happened with the US dollar. But copper is struggling to meet existing use demand. I've talked about nickel in previous videos. And BHP, one of their spokespeople, was out during the week saying that copper production would need to double for the next 30 years to meet new demand, which is a pretty big statement coming from BHP. And so that raises the question, where does that level of production come from to meet that new demand? So therefore, you'd have to say that it's going to be very difficult, even for the majors, to develop the large mines that are needed to meet that additional demand. And so therefore, mergers and acquisitions are almost a given. Now, I would never recommend you go out and buy some copper stocks on the hope that you might get a takeover offer. You know, that's a foolish thing to do. But certainly there is going to be a backdrop of mergers and acquisitions in the market, and what that's going to mean is that a lot of potential targets are going to get, they're going to see their prices more buoyant than otherwise would be the case. Now, crude oil, which slipped, it was only a couple of weeks ago, it was over $80. We're now down to 66. So there's been quite a dramatic shift in crude oil. So just a quick look at the charts. There's copper, hasn't done much. Nickel, pretty much the same, ticked up a little bit on the week. So that's the situation. And my final thoughts to wrap it up, there's no question in my mind that the reward for risk has shifted. Now, that doesn't stop the market from continuing to rise. But I think what we're going to see is a significant shift in in the composition of what's performing and what's not performing. There's just too much weight of evidence that for that not to be the case. We don't have absolutes in the market. No one can ever be sure of something happening. All we have is probabilities and weight of evidence. You forget logic, because logic tends to be based on things that have happened, things that we can see now, whereas the market is always looking forward, and that's why logic often doesn't work. You can forget the news. If you're trying to trade the news, then you're light years behind. So you've just got to forget about those things. The charts are telling us to be careful. I'm now shifting to a more cautious stance, and we've got this dilemma of controlling. How do the central banks and how do the governments control inflation while keeping growth going? And all of that is at a time when we've got a lot of high valuations. Now, there are some stocks that still offer, and I covered this with Microsoft as an example a few weeks ago, where the valuations look high, but if you look at them in proper context, they're actually not. But there are a lot of stocks that are trading at very high valuations. And so now the market is thinking, well, we thought inflation was transient, that it was just going to go away again and growth will continue. Well, now the market's having a rethink. And as part of that rethink, there'll be a repricing of risk. And that means that we're going to see continued volatility. And in some parts of the market, we're going to see continued downside. So that's how I see the market at the moment. Now, portfolio analyst last week, I looked at the lessons of March 2020 that we could take from that. What went down the least, what recovered the quickest, and what went up the most in the following 3 to 6 months. So I think that was a pretty good exercise. And I don't see why something similar won't play out this time. However, the trigger is going to be somewhat different, because coming out of March 2020, the trigger was about which stocks would do best in a lockdown world. Now it's going to be a matter of what stocks do best in a higher inflationary and possibly higher interest rate environment. Another section that I looked at was the sort of criteria that you want to pay attention to if you're looking for the next Amazon. Now, it's not a difficult thing to identify the possible next Amazon. The really difficult thing is learning to live with it over a couple of decades, because even Amazon at one stage fell 90% and several times fell 50% over that 2-decade journey. So it's not the easiest thing in the world to do. We also looked at making some adjustments to the portfolios, which also reflected what I was seeing in the market. So quite a lot in portfolio analyst last week. That's it for this week. There's more information on the website. There's my email address, and I'm sure we'll have a fascinating week. I'll be back with you next Sunday. Cheers.